Hello, everyone, and welcome to The Currency Exchange, a NatWest podcast series focusing all about foreign exchange markets. I'm Brian Daingerfield, and I head the G10 FX strategy team here in the U.S. I'll be hosting today's pod, and today I'm happy to be joined once again by Paul Robson, who runs our G10 FX strategy team over in London, to discuss developments in European and major FX after a pretty important week, sort of an update on our episode last week where we talked about a lot of the themes in these two regions. So, Paul, thanks very much for joining.
Well, thanks very much for the invitation. Like you say, the events keep coming and the data keep coming, and it looks like an interesting landscape for major currencies. So lots to discuss as normal.
Absolutely. And so I want to start with the Bank of England. We are recording on Thursday morning here in the US. And so we are just fresh off that decision from the Bank of England that we got on Thursday. Paul, what are your snap reactions from the Bank of England decision? What did they do? And did anything in this decision surprise you?
Yeah, there's lots of moving parts to today's Bank of England decision, but I think overall a sort of dovish hold from the central bank, and maybe that's actually pushing it a little bit, maybe this, slightly dovish hold. I think the key takeaway in terms of the guidance, because on unchanged rates, it was always going to be about the guidance. And there I thought it was more about evolution rather than revolution in terms of guidance. They could have made, or they would have had to have made, I think, more significant changes to the guidance if they wanted to move market expectations significantly. As we discussed last week, we always thought there were three areas that we would need to focus on. One was the vote count. The other one was the CPI projections, which I think actually are the most important aspect of today's sort of announcement. And then it's the overall tone, the rhetoric in terms of the guidance, what the MPC chose to stress, and in terms of what they might need to then before sort of considering changing interest rates. On the vote count, there was actually a surprise. So, well, certainly to us and certainly sort of half the market. So in terms of the vote count, it was 7-2 in favour of unchanged rates. There was a second MPC member voting for a cut in interest rates, which was quite interesting because Ramsden, who voted for the cut, was one of the more hawkish members of the MPC. So he's had this conversion from one side to the other relatively quickly. We thought it was going to be 8-1. I'm not sure it changes the outlook dramatically because it's all about the centralists. Those people who are sort of had balanced views are going to have to shift before a vote to cut interest rates. But of course, we now only need 3 votes to move, and that brings the a cut in interest rates a little bit closer. The CPI projections, I think this was the important part of it. So if I think about those numbers, so on the assumption of no change in bank rate over the forecast period, the forecasts were relatively unchanged. I think they were a little bit higher than previously forecasts. But the crucial one, once you start making the assumption of what markets are pricing in terms of interest rates in the UK, then those forecasts were marked quite significantly lower. And the explicit guidance there, the Bank of England telling you, or the markets, that they need to price in more easing from the central bank over the forecast horizon. So that was quite specific. And back in the day, that was the main policy guidance, but markets seem to have become a little bit desensitized. The overall guidance was little changed, needing a little bit more evidence. Rates would have to be high for some period to get inflation sustainably down to target. There was a little bit tweak on the service sector. They said that service sector inflation, which is important for the persistence of inflation, was coming down, although it was elevated. But the down bit was added. So maybe just at the margin, that was a little bit dovish. But I think the key takeaway is the central bank needs more evidence, more data. That might actually come next week, actually. We can talk about that before easing policy.
I really like the way that you phrase it there, evolution rather than revolution of policy, where maybe a modest step in the dovish direction rather than a wholesale step in the dovish direction. But as we turn to sterling here, I know this is something that we had been expecting, a shift in the dovish direction from the Bank of England. And I know you've been talking a little bit more about the possibility of interest rate divergence and its potential impacts on the sterling. How are you feeling about sterling now as we're through the Bank of England decision? And what do you think should be the focus for investors as we think about sterling valuations?
Yeah, I don't think the outlook for sterling changes dramatically after this meeting. As you say, we recently changed our bias to be more cautious on the currency, looking for the currency to perhaps weaken a little bit against some other European currencies, and we still hold to that view. Again, I come back to that sort of evolution of policy, and I think as we go through the next couple of months, as the data are published, and if they're in line with our expectations, our economics team's expectations, then confidence will grow that the Bank of England is going to ease policy beginning in August, and importantly, that maybe we'll end up cutting interest rates more aggressively than markets currently expect. And the currency has tracked interest rate expectations. And so you put those two together, you marry those, then it suggests that sterling might continue to trade weakly. And I think that's the dominant story for sterling. I don't think there's a sort of relative growth story. I don't think there's any sort of specific risks around the UK economy. Maybe politics as we go through the year might become a greater focus, but we've got plenty of time to talk about that in other podcasts and later on in the year. But my focus is very much lasered on interest rate expectations, and today I think we're moving along the steps to a more sort of easier policy and maybe a slightly weaker currency.
So I want to move on here and talk a little bit about another central bank. I mentioned, and you mentioned evolution versus revolution in the dovish direction. I want to touch on an economy that seemed to have gone on the other side, more revolution than evolution, and that's the Riksbank. This was a very close call from the Riksbank this week, whether or not they would cut or leave policy rates on hold. Paul, what did the Riksbank do, and how does that feed into your views on the Swedish currency?
Yeah, I like the way you sort of turned that around on me. Certainly for the Riksbank, they were more aggressive. They cut interest rates a quarter point. The market was sort of about 50-50, undecided about what might happen, either unchanged rates or cutting. Market economists were a little bit more confident that the Riksbank would cut rates, but it was a surprise to interest rate markets. The key focus, I think, for why it could have been one or the other was the currency. I think the central bank might have been a little bit cautious about cutting interest rates ahead of the ECB, ahead of the Bank of England, ahead of the Fed. Obviously, they join the SNB now of being the second European central bank to cut interest rates, but they delivered on it. And simply, it's the data that matters. I think you've previously talked about not being sort of Fed dependent when we're talking about the ECB, and the Riksbank made that very clear. And to be honest, to be fair to them, they've been saying this all along, that they could cut ahead of other central banks, and they delivered on that. The currency was a little bit weaker on the day, but not dramatically so, given that it was a surprise to interest rate markets and currency markets. And maybe that just hints that the weakness in the Swedish krona that we're going to see is probably done for now, maybe positioning in favor of that. But we'll be watching to see how it trades against sterling, for example, and the Norwegian krona, where we think the Norges Bank are more confident in keeping rates high for longer because of a sort of Pacific oil investment story there. But I think the other key takeaway from the Riksbank is it just shows that elastic between European central banks and the Fed is probably a little bit more stretchy than markets have expected. So central banks in Europe are going their own path and not being beholden to what the Fed does on rates. And I think that was ultimately a key takeaway from this central bank policy decision this week. And maybe that's just a good point to turn to the Fed. We've got US CPI next week. That some of the data's been a little bit more volatile. What are you thinking about the data, the Fed, and ultimately the dollar?
Yeah, so the dollar's been in a bit of a holding pattern over certainly the past week as we've awaited this key data, and really more of the interesting developments over the last week have really come offshore, specifically some of the things we've already discussed on this podcast. But I think we're all looking ahead to the CPI in particular as the next sort of bellwether for the dollar. The most recent data that we've gotten, both on survey data and unemployment, did come in a bit softer than expected. The survey data from the ISM PMI data, for example, those came in notably weaker. I would call the non-farm payroll report we got last Friday more Goldilocks. And in both cases, I think essentially you're clipping the wings, sort of the tail wings for the dollar in terms of very hawkish reacceleration in the dollar type expectation. So if you think about the base case having shifted away from imminent rate cuts and towards higher for longer in the in sort of the recent CPI landscape where the inflation numbers have come in a lot stronger. I think the softer data we got on employment in the ISMs has maybe clipped a little bit of the top side extreme cases where the market's still in a higher for longer camp in terms of absolute pricing, but maybe clip some of those extreme scenarios, as in what does it take for the Fed, for example, to consider rate hikes again as coming back on the table. Powell and the Fed seem to push back against hikes being on the table at their most recent meeting in early May. And these data seem to push in that direction, that the bias is towards higher for longer rather than an extension of the hiking cycle, or a resumption of the hiking cycle, I should say. And so the dollar has treaded water, and it's weakened in some cases off of its mid-April highs. That includes against euro and against other currencies as well. But I think the market continues to very closely follow the data, and specifically the inflation data, I think, is what's going to end up driving in the end. Paul, you mentioned that relative rates and nominal rates for sterling has been such an important driver, and I think it's probably fair to say that's true across a number of currencies in the G10 space. And I think that rates markets and the dollar are going to take their cue specifically from inflation, because the softer growth data that we got recently is certainly encouraging if you're a dollar bear. But you can only, I think, extend that so far unless the inflation data also start to move more clearly in that direction. Very similar to where we were at the end of last year when the dollar was weakening because the inflation data were allowing it to weaken. The inflation data, I think, are going to inform on how much the dollar can extend weaker or be forced in a stronger direction, because it informs so clearly on expectations for the Fed, just in the sense that the non-farm payroll may have clipped some of those extreme hawkish pricing in the market. The CPI could bring them right back on the table. And unfortunately, I think we're looking at the latter as more likely in this case, as we're looking at the core CPI next week on the 15th of May as the biggest release of the upcoming week. We see a risk that the core CPI actually rounds up to a 0.4% unrounded, which would be a quite strong result for US inflation, and one that I think continues to push off this point of peak hawkishness for the Fed, and one that makes it really challenging to have a sustained dollar weaker expectation here. Now, of course, as the growth data are weakening, if we were to get a surprisingly soft number in line with the softness we've seen in some other indicators, that could get the market back into this sort of a bit more excited about the prospect of pricing towards softer, a weaker dollar. But we're just not seeing it in terms of the underlying expectations. And so we remain cautious here on the dollar. We certainly had, our expectations on the dollar have been very closely linked to our expectations for inflation. Earlier this year, when we were feeling more confident that inflation was very close to starting to come down, we were leaning into this idea that the dollar could potentially weaken. Now, as we're a little bit less confident in that outlook, we think it's more appropriate to be defensive here. And that's how we're approaching the CPI next week in the context of that. We've had weaker data recently, but the CPI is ultimately going to be the big driver for rates, and I think for the dollar and for Fed expectations. And we're unfortunately looking at a pretty solid number, we think, which I think could boost the dollar here if we get it.
Yeah, no, all very clear, and that link between currencies and interest rate expectations, it's the one that's dominated currencies this year, and it feels like it's going to continue to dominate. But the one dollar exchange rate that continues to move, ever seems to be moving higher, it is dollar yen. It felt like, given the price action we saw, there wasn't any intervention this week. I think it was confirmed that we have had it in recent weeks. So just thinking about what your thinkings are on dollar yen here, given that lack of intervention moving higher, and given your overall dollar expectations.
Yeah, I think the market is trying to figure out the conditions under which intervention is or is not going to happen. And I think this week, now that we have not had any obvious interventions, last week it seems like we certainly did have interventions. As you mentioned, it's all but confirmed at this point that there were FX interventions. One of the things that I know the market is looking at is the response from the US. And there were some comments from Treasury Secretary Yellen noting that FX interventions would be tolerated if they're rare and that if there's previous consultations. And so I think what the market took away from that is that the prospect for the MOF and the Bank of Japan to be in the market very frequently is probably something that the U.S. would not look well upon, and so maybe a little bit more complicated from a from a geopolitical perspective. And so maybe that's something that's reducing expectations in the market, that the MOF could be in the market on a somewhat predictable, steady basis, and maybe reducing expectations for more consistent, persistent yen interventions. And that's something I think has weighed on the currency, on the yen this week. Another thing that we've all, of course, been watching is, we talked a lot about relative rates. Very interesting to see U.S. rates lower in the aftermath of some of the weaker data that we've had at the end of last week, the survey data and the non-farm payrolls. U.S. interest rates lower across the curve in response to that. As I mentioned, we're still looking at a strong CPI, so we're cautious on necessarily thinking that that move can extend in favor of a weaker dollar. But in dollar yen, you've actually seen the opposite reaction, where U.S. rates have fallen, but dollar yen has picked up. And I think this reminds that interest rate differentials matter for currencies, but it's also a factor of what interest rate moves mean for broader volatility and for broader risk, right? Because when interest rates are rising, if that's rising in a way that's moving market volatility higher, that could be hurting traditional carry trades and supporting the funding currencies like the yen. In the case that we've had recently, this weaker data that we've had in the US has actually led to lower market volatility, where you have the MOVE index of interest rate volatility, for example, has fallen back from its post-April CPI highs. The VIX index has also moved back lower. And of course, US equity markets have rebounded here as the market is pricing not just a more dovish potential Fed outlook, thanks to some of the softer data, clipping those hawkish extremes that I mentioned, but also anticipating more dovish outcomes across the world. That is, you see the possibility of the Fed maybe turning a bit more dovish. Maybe that gives other central banks a bit more room to stretch this elastic, as you sort of called it, Paul, to stretch this elastic and maybe move a little bit more aggressively as well. And so these lower rates in the US have brought with them, or at least have coincided with, lower market volatility, and that tends to be a better environment for carry trades. And the yen is the undisputed carry trade funding currency. And so we have this interesting dynamic where interest rate differentials, when they're widening in favor of the dollar, the pressure on dollar yen is very consistently to the top side as markets hawkish repricing pushes this divergence wider. Now you're in an environment where you see rates coming off a bit, but yen is still weakening because the rates coming off a bit are moving volatility lower, and it's generally a positive for carry trades and for risk-sensitive currencies. And so sometimes you look at this market and you look at the yen and you say, so many roads seem to lead to a weaker yen, and it's very hard to construct a very positive outlook for the yen. I think in order to do that, if you think about this volatility and rates framework, you probably have to find yourself in a lower rates, but in a more volatile way type of environment. So you're talking about significant weakness in US growth data, for example, significant weakness in global growth data, a big risk off style reaction. That's what might be needed now for the yen to have a more sustained rally here. And it just does not feel like that's in the cards. If anything, the growth data globally have stabilized in many cases and have accelerated in the US, albeit recent data have been a little bit softer. And so it certainly feels like most roads are still pointing towards a weaker yen. And for the MOF BOJ, I think the question is how much of that weakness, what type of weakness are they willing to tolerate? And do they consider this out of line with fundamentals? Or do they consider this a natural response to the volatility environment as well as the broader risk environment and the movements in relative yields? But very interesting to see yen continuing to weaken off of its post-intervention highs, despite the fact that you've had those lower rates. And I think that volatility risk kicker is a big part of that discussion. So I think that's all the time we have for today. Thank you very much for joining. Thanks, Paul, for running through your thoughts as well. And thanks for listening, everyone. If you enjoyed this podcast, please consider liking our channel and subscribing as well so that you get our latest podcasts once they're released. Thanks very much.